I know you I know how you're a roller like that, so I didn't know what kind of a pool we're talking about here, Michael.
Something kind of shocks my system, and yeah.
Oh, you're doing the cold thing.
No,
Okay.
no, not yet. Though, of course, we're both surrounded by go abundance freaks who do these crazy things. But no, I am light years away from the cold plunging, and
Oh man, I
I have
used
a
to
lot of
do that.
respect for that. Matt, welcome to the show today.
Thank you so much for having me, Michael. It's great to see you again.
This is great fun. What's new with you, man?
Man, I really like we crushed summer in my family. So that's going on a personal note, with my kids in school, both of school age, right? Like you got to go all in, man, on summer. And so we took the family to Costa Rica. We spent a lot of time with local friends. I got to hang out with a bunch of my syndicator buddies down in Dallas at an event that you put on. So which was incredible, so much fun. So there was let's see, then we went to Virginia, and just in between them, just spent a lot of time just outdoorsing and stuff. I really feel like, Michael, I've been outside more than I've been inside this summer.
You look like
And so really lucky and blessed to have a great summer. So we're getting towards the end of it here. A little sad that it's over, but also not sad because we nailed it. So I'm glad we had the resources, the means, and the time control to really own our summer and slay it hard.
yeah,
So,
that's awesome. We just got back from Europe, spent 3 weeks there.
man,
I went to Germany to visit my parents. Spent a couple of days in Vienna, Austria. I have a sister there, and then we took a 7-day cruise in Croatia and Dubrovnik and other places, and then spent 4 days in Paris. So we got a pretty good Europe sampling. And one of the things I love about Europe is there's just so diverse, different cultures.
yeah,
Drive an hour, fly an hour, you're in a different language, different universe, and it's really cool. So got to do all that with my family, spent a lot of time together with the family, which is really
yeah,
we actually get along with our kids and really enjoy them. The two of them are entrepreneurs, and so it's good jamming
that's
with them.
great.
You
You've
know,
been great about exposing your kids to your business, and every time we come to Dealmaker Live, I mean, I see the Blanc family running around, putting them to work and having them on, just being a part of the team and I think I really admire that.
yeah.
Yeah. By the way, one funny story. I know some of the people that you went because it's kind of a joint organization you and I are a part of for the Croatia thing, right?
Yeah.
I had to Google where Croatia is.
Yeah.
Isn't that funny? I had to look. It's like it's like the other side of Italy, right? It's like the boot of Italy. Italy's kind of like kicking a soccer ball into Croatia, right?
Yeah.
And I didn't realize that it's right there. It's probably going to be just as beautiful as the Italian coastline. So when I saw that, I'm like, okay, now I'm jealous about where Michael and some of my other friends are.
It was good. It's you're hanging out with these high level successful entrepreneurs
Yes.
on a boat for a week, and it's great. But it wasn't that kind of hangout. It was like people really were they just wanted to be on vacation. They didn't really want to do a bunch of masterminding, which was
Just to chill out. Yeah.
chill out. And I think that's cool because we all just strive so hard all the time, really, and it's good to just chill out for a little bit.
Oh yeah. That's a good place to chill out too.
I
So
think when I catch up with you and just kind of just jam a little bit, just you and I. We're part
yeah,
of a
man.
time together. It's actually something that we don't even pay for. It's just something that we created years ago, and back when we had several hundred units, and a bunch of us got together, and and now we kind of grew up with each other, and it's been a lot of fun to do
Had
that.
each other's back too. Like looked
Exactly.
out for each other. Like, yeah, man, don't do that. Because I did that and that didn't work out, kind of thing. So yeah, it's been great.
And it's been useful for me because, and this is kind of what we're going to talk about here. I think the last time I was on was, I think 4 or 6 weeks ago. I think I missed our last mastermind because I was gallivanting in Europe. So it's been a little while since we caught up. And this is kind of a jam session, I think, for everyone watching and listening to this, is to have a group of peers around you that, are doing what you're trying to do and can support each other. And, between the 9 of us in this mastermind, we really have a very deep perspective on what's going on and what we're going through. And, I've experienced something that you haven't and vice versa. And so we can kind of lean on each other in this way. So, it's kind of what I want to do with you today here. So what's going on in your business right now? Like what do you think is like going well, and what's maybe not going so well or
Yeah.
It's always those two things. Things going well, you're crushing it, and then you've got challenges at the same time. Keeps life interesting. But what's
You
going
know,
going well right now?
Sure. Michael, when you own apartment buildings, it's like you own a bunch of little businesses, and in some ways they are related to each other with only, but in regards to like best practices that you can bring and operational strategies and protocol and that kind of thing. But at the end of the day, the revenue streams are unrelated because it's different market, different demographic, different tenant base, different everything, right? And the expense load can be different and everything like that too. So it's almost like having like a bunch of little children. Some behave themselves, some do not, so I've got my problem children. I've got my apple polishing, lovely little children that just can't do anything wrong, and they're like my little favorites and stuff like that. So, the properties that we have that are going really well are ones that obviously are on, like shocker, stabilized debt, right? Fixed rate debt that we refi. I got one property, Michael, it's at 3.1%. Can you believe it? And we thought, and we were like a little bit mad, like, man, I really wish we got it 2.9 or whatever. We were like throwing rocks at 3.1% when we got it. Now, like, I'd literally crawl over broken glass to get 3.1% again, right? But we have that. It's fixed rate for years and years and years. And then we have floating rate stuff. And I'm lucky enough, and I think partly due to our mastermind, that a lot of us saw this coming and stuff like that, that we, shored up our boats and took in some strategies that you and I both did and stuff like that in our businesses. And, we had to raise more equity from one of our deals from our investor base to tighten up things to make sure we had enough reserves and that. So we've had to do that. And that's those properties are stabilized and are continuing to round the corner. The properties that we have that are really, really sucking wind, and we got one of them right now, Michael, just is like one that there was unforeseen, unexpected construction items, major construction items, like replacing the staircases, construction items that we didn't think we are going to have to do. So you get in and we all end up having to like rip out these staircases and put them back in because they turned out being more structurally unsound than our structural engineer had thought that they would. And the town showed up and put a violation on them. Right. So we fought the town, said, no, wait, our structural engineer said, and they're like, no, we say that these are condemned. And so we ended up having to do a lot more construction work than we thought. Tie that along with floating rate debt, and you got a property that's really, really hurting. And so that's probably my biggest problem child right now. Happy to go further. What do you got?
Yeah, I know. I think the problem with this floating rate debt, I mean,
yeah, man,
I will have interest rate caps, and those are capping it. The problem is, it takes 1 or 2% to get to that cap, and that 1 or 2%, while it doesn't sound like a lot, is a lot. And so what it's doing in all portfolios as well, it's amplifying any kind of operational issues you might have. So in a normal environment, it means that you're in a more stable environment. You're not having to deal with financial issues and interest rates that you don't understand or control. And so these things are amplifying operational issues. So it's one of those things. And on the one hand, when you look on social media, everyone's talking about how successful they are and how great how great they're doing, and that's irritating because the truth is elsewhere. On the other hand, you don't want to get to the point of the 1 out of the 10 that's kind of sucking you dry. But it's kind of like that. It's like 80% of your portfolio is doing well or reasonably well, and then you got that 20%. It's the 80-20 rule. That 20% is taking up 80% of your time. It's like that for us, and it's like that for any syndicator who has a large portfolio. Like you said, it's a portfolio approach.
Yeah.
And unfortunately, that bottom 20% is just sucking you dry time wise. And we have one property. We're probably on our 7th manager there now, right? And so the management company just cannot produce someone who can manage that property. And it's in the same area. We have other properties. It's in actually a relatively good area. All the comparables are doing well. For some reason, the humans cannot run this thing to the point where, and here's the problem with the situation is when you're trying to get out of floating rate debt, which we all are, something more, fixed rate, government backed of some sort, man, you got to be 90% occupied.
Right.
84 or 89.5.
Or not, you're right, not 88 or not 89. I mean, we looked at a deal right now, Michael, to buy, and I feel for this guy, the seller. He's at 87% occupancy, but can't get any higher than that. And I'm like, I'm over here looking at the deal. I'm okay, I'm going to have to use bridge debt, which
Yeah.
is going to cost me today 11%, right? 11. There's such a disparity between bridge debt and agency debt cost that the offer we could have given this guy was probably 20% less, 20% based on 3% occupancy. Now he could have just puffed it full and got it above 90% by just putting people with a heartbeat into those units, but that's not going to stay up through closing, right? So it's there's such a disparity between we really need is, again, if you and I had a magic wand, there should be like a better product. Maybe the agencies get into a little bit of bridge, maybe like a baby bridge kind of program or something like that, where it's like,
Especially now.
yeah,
Especially
yeah, give
like,
me 80% occupancy that needs a little bit of reno, right? Give me that. And there's a lot of difference you and I could make, and a lot of housing we could shore up in this country if we had a little bit of bridge with agency rates,
Yeah, it's a tough gap to close for both buyers and sellers. And there still is, on the deal flow side, there's still not a lot of volume out there because sellers who don't need to sell are like, yeah, I'm just going to wait till it comes back again. I'll just ride it. And then are you, on the other hand, I think there's going to be a lot more opportunity. Have you seen?
I'm starting to.
Yeah, it sounds like this particular person is
Yeah,
example.
I'm starting to. I've seen one deal in the market for sale for less than what the seller paid for it 2 years ago. Right. So that means it's straight up like, I'm willing to take a haircut. I'm going to lose money, investors' money, my money. I'm going to lose money on this deal because I'm selling it for like 105 a door, and this guy paid 110 a door for it. Right. So we're seeing that. Go ahead.
Why they are selling? Like, why are there going to be opportunities coming to market either on or off market?
Okay. That deal, they went in undercapitalized. And that's the biggest lesson anybody needs to hear, that if you're bidding deals right now, or if you're looking for opportunities, look for people that went in undercapitalized. I'll explain what that means in a second. And if you're going to do deals now, you may go in overcapitalized. Undercapitalized simply means that they went in with not enough money and not enough contingency and not enough, oh shoots, things might happen, and what might hit the fan for a little bit, so I need to have some money to bridge. That's undercapitalized. If you go in with exactly the dollars you need to renovate and exactly the dollars you need to execute a business plan or whatever, it might produce a higher investor return if everything works, because you went in with less money. You had to raise a little bit less equity. But if anything hiccups the wrong way, in this deal that we're particularly talking about, Michael, two things went wrong for the seller. Number one, they didn't do a sewer line inspection, and they didn't see that a lot of the sewer lines had tree roots inside them. And so the sewer system started backing up. This is an older vintage, not a 70s, it was an 80s vintage, right? But the sewer system started backing up on them, and now they're going to end up not even rooting them out. They had to dig it up and replace all those sewer lines. Cha-ching, right? Second, they didn't get a valid roof inspection, and they didn't realize until later that some of the roofs didn't need to get patched, Michael, needed to get replaced, right? That's one thing. Those are two things. And the third thing that hit them, which this property is in a low-lying coastal area, and so insurance. They are currently paying $300 a door in insurance. The bids that we got, Michael, $1,200. And it wasn't a floodplain, but it's in like what they call a air quote low-lying coastal area, which is, well, do the math. It's close to the coast and it's lower elevation, right? So the bids that we got were $1,200 a door for insurance, given the spikes that we had. So those things are going to have pushed the property value down to the point where they really just need to get out unless they really want to lose big.
Yeah. Yeah. I think you're going to get a lot of that. There's people starting to sell because they have these interest rates, these caps expiring. And the properties aren't really performing that well, so they can't actually raise additional equity because no one wants to throw good money after bad. They're like, no, I'm out. I've already written it off in my head. And they're like, oh, yeah. What do I do? Do I give this up? I mean, I could return the keys to the bank, but now obviously everyone's going to take a basically 100% loss. And now I get blacklisted probably, and I can never do the freaking Fannie loan again.
Yeah.
So let's sell for pennies on the dollar and avoid at least a complete and utter capital loss. And so I think you're gonna the challenge is gonna be, Matt, and this is I'm struggling with in my mind is we're going to start getting later this year, probably start getting a lot more of these opportunities, especially like into next year.
Yeah.
Problem is raising the money for it. I mean, I still think that right now people are still afraid. They're
Hmm.
still afraid to deploy capital, especially if they're already in some multifamily syndications and their distributions have slowed or stopped, or
Yeah.
they had to fund a capital call. They're like, you know what? I don't know about this thing anymore.
Yeah, not gonna do this again, right? How about I just keep my money in my money market savings account and earn what, 4.5, 5%? Jeez,
Exactly.
that's almost a pref right there, you know?
That's right. And so that's what that's what we're dealing with, you know. But
Yeah,
like this deal that you're looking at here and the one we closed on now 4 months ago, those deals are like night and day from they were even a year and a half ago. Like the interest rate is completely different. The interest rate,
sure.
the debt structure is completely different. Like you said, the insurance costs are much higher than they were. So we're going in. You could argue that 18 months ago we were at the height of the market. I mean,
Yep.
price. Now you could argue now that we're like towards the bottom of the market. I don't know if that's the bottom, but darn close to the bottom
Hmm.
of prices, at least in the medium term. I don't know what you think of
Hmm.
that, but therefore, I mean, within 18 months, we swung from one extreme.
It changed quick. I don't think we're at the bottom yet. I think that we've begun the correction where the overpricing of the market it just isn't. It's just not big. It just hasn't fully baked in yet. Real estate always tends to respond slower than other industries do. By the way, that deal that I just told you about, the deal with the guy selling it for less than what he paid for it, we passed. How about that? Even with everything, we passed because of insurance, because it was still hard for us to make it work. That was a big insurance bump. And my partner looked at it and said, hey man, low lying coastal, like maybe what if the insurance goes to 1,500 or 1,600 or keeps going? I mean, at what point do we just say, uncle, again, it can't go to like 10,000 a door, right? It can't go up forever and ever and ever, because then these whole regions should just become, okay, I guess America can't occupy the
Never,
low-lying coastal parts of the country anymore,
never say never. I mean,
That's
there's
true.
big insurance companies start pulling out of California and Florida where you can't even get insurance anymore.
Yeah. 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 So I talked to our insurance guy. I think you and I use the same carrier, but just for to be friendly, we don't have to name them. But I think that we use the same carrier. But I talked to one of the guys over there and I said, what's the end game here? Like if we're going to 12, 13, 14, 1,500 a door for a lot of these properties, it's like, where does this going to go? And he says, well, what's going to happen is these rates have gone up so much that it's going to allow for new players to come into the market. And he said, like big fish like Grace, Greystar, the property management company, right? The largest PM company in the country, I think, right? Now, if Greystar manages your real estate for you, they will insure it for you too, right? Think about that. PM companies are starting to get into the insurance business. So I think that we're going to see more players. Like what if Fannie Mae is a bad example, right? But what if a insurance company that was the lender on the deal, right? Because insurance companies will lend, for a place to place their capital. What if they say, hey, listen, I'll knock your rate down by a quarter point if you let me insure it too, right? I think we're going to see more players come into the multifamily insurance space, and that's what's going to make it more competitive, which is what we need to get more competitive.
Other product would be super interesting is a cap on insurance rates. Like, I mean, that's the biggest thing. You would probably underwrite 1,200 and the deal would work. But kind of like these interest rate caps, no one had any idea it would basically 10x, 50x. Like if there was some kind of insurance for the insurance.
Yeah, I was going to say that. You're talking about insurance for insurance. Yeah,
Like,
but if you approach me with that, a like doomsday scenario insurance prices, okay, I will insure you that your rate will not go up anymore. Your premium won't increase by any more than 6%. I would bake that premium into my underwriting. I mean, like, what would it cost?
exactly.
Because then I can fix expenses. You're right. I can, and the concern is not what it cost me the day of closing. The concern is it going to go up by another 40% next year? Because how do I underwrite to that? It's like crystal ball here, so that's what I agree. I think that's probably what we're going to see coming. I think the insurance world in multifamily is going to change because it's going to start there's definitely a problem, and problems in a lot of ways create opportunities. Probably not going to be me that's going to create it. And we've even talked about getting a bunch of, I'll tell you one thing that you and I've talked about is getting a bunch of owners together to say, hey, I'm owner A, this is owner B, and then owner D through H. We're all going to put our portfolios together and just use it, just use it for a leverage bargaining agreement, or do captive insurance, or do something creative. I mean, just so we could use our strength in numbers. Let's do something together.
I think it's just times like this where we as entrepreneurs have to become creative in general, right?
Yes.
In general. I'm gonna talk about kind of scaling our business a little bit. I would say probably after 2010, it was relatively easy to scale because, that's not entirely true because it's always hard to get a deal done.
Hey man, this business has always been hard, brother.
it's all
I don't remember this thing ever being easy. I remember in hindsight, it was like, man, I sure wish those days were back again. But
You're right about that. Let me rephrase what I'm about to say. Is if I observe companies, especially when they start out multifamily or some other asset class, in order to preserve, in order to scale in a meaningful way, and let's say you and I will do 4 deals a year, 2 to 4,
Yeah.
which is great.
Mhm.
When you got 100 million, 200 million in assets, right? But if let's say you have $1 billion in assets, you doing another 2 to 4 deals a year isn't really going to ensure that you grow at the scale you might want to grow, right? And
Mhm.
so you either obviously do more deals or you do something else. And it's very interesting to see how companies what they do to try to scale. And I just want to get your perspective on that because I'm sure you've grappled with this. And
Mhm.
obviously, when you're dealing with market issues like we're dealing now, it takes a lot of attention away. It's not like I can take all of my energy and now pour it into growing my company. No, I have to take a significant amount of energy to actually operate well,
Yeah.
and so I can't. I mean, I can't really do both. I am trying to grow, but a lot of my energy is being consumed on the operational side, which, of course, at the end of it, the operation will be better because of it. I get that. It's still
Yeah.
irritating for me because I'm a growth guy, not to be able to take my entire energy and just kind of move forward with that. And how are you solving that? And if you're not solving it now, which I won't fault you for the reasons I just said,
Mhm.
your mind, if you had a magic wand and you could solve all the things that are sucking up your time and energy right now, what is your vision for scaling your company?
Well, I mean, first of all, just like you, I got great people. That you and I are just the pretty faces of our companies, but we're not the only operators of our companies, right? Like there is a team behind me and two partners, almost exactly like you. I got two very strong partners behind me, just like you have two very strong partners just behind you that are doing a lot of the help scaling too. That's number one. Number two, the mistake. I want to scale too. I want to grow as well. I ain't done yet, kind of thing, right? But I think that you got to scale smart and you can't force a square peg into a round hole. So I think that there's two mistakes that one could make in scaling now. And you and I will not make either one of them because we're just, aware enough to not do this. Mistake number one that you can make is by scaling, I think, in like only one section of your business. So let's say I decide to go super like hardcore on raising capital and I'm going to create the machine to lever like $50 million in equity a year to my company, but I don't do anything on the acquisitions and on the ops side. What that's going to do is it's going to create a lot of money coming in, and I'm going to have to force a square peg into a round hole on a deal and overpay on a deal and allow myself to get pulled into best and final, best and final, best and final, and then pay like 10% more than the guy behind me in line, right? Because I didn't scale my acquisitions game. Secondly, I then have to take all that equity I just raised for the deal I overpaid for and put it into a mediocre operations business that I didn't invest in, that I didn't scale, that I didn't put the right people in. And I know you guys just hired an asset manager, which, we did too recently, right? So we're making the right investments there. So that's a case in point of what the right things to do in scaling. So the short answer is the right way to scale is to scale all facets of a company: equity, operations, and acquisitions, right? And that's what we've been working on doing now. Everything from like considering different management strategies, including managing maybe on our own in some markets or something like that, for property management, or just different ways to get equity, different ways to acquire deals, maybe starting to talk to banks for deal, maybe not just talking to brokers to acquire properties. Scaling acquisitions could look like looking in other markets and also looking at other resources. So that's how we're trying to scale. Certainly not like, let me scale by finding more deals. No, you got to scale by doing all the buckets of a multifamily operation.
I found that most syndicators who've done a handful of deals or even have, up to 1,000 units, that is their scaling plan. It's just, well, let's just do more deals. And to some degree,
Yeah.
it's not the same thing. We'll just go and do what we did last month. And we found that doesn't really work very well. And you're right. You have to really focus on building a business. I have, like, in my mind, Matt, I think I came to this while I was Deal Maker Live, and I was thinking about the levels. There's always another level, Matt. Always, right?
Mhm.
You're like, oh, I'm at the top level. No, there's always another level above you.
There's always somebody ahead of you in line, right? There's always somebody bigger. Yeah.
Let me get you. So level one is you do deals. Okay, you're the
Yes.
deal maker. You do deals. You're happy. Blah blah blah. And then level number two is when you decide to build a company. Like, you actually
Yes.
go, oh my gosh, I have a company. I actually have to build a company. Like, I'm building a company. Like, that's level
Right.
two. But there's two other levels, Matt. Check it out. Level number three for me is building a company that runs without me. So I call it, I want to move myself in the owner's box, right? Whatever book you're reading, it's who, not how. It's, I want to clockwork the company. Okay.
Traction, all that stuff. Yeah.
So that's cool. Okay. But now I
Yeah.
discovered a fourth level.
Tell
The,
me.
the fourth level is when you basically have different lines of business under an umbrella. Okay. So here's what I mean. So for Nighthawk, our investment company, right? So when an investor calls in, they want to invest with us, we have obviously existing cash flow multifamily to invest in. And that's fantastic. It's probably the best investment class in the world. Okay. But there are other types of investments within real estate have different risk profiles. So what if, okay, and you and I have talked about this, what if we could offer a different kinds of asset class, for example, a debt fund? A debt fund has no appreciation whatsoever, but it's all cash on cash return, right?
Cash flow day one, though. Yeah.
And then maybe down the road, we create a ground up development fund, right? And there's no
Yeah.
cash flow at all, and it's just all appreciation. And then you have your cash flow multifamily in the middle. And I think to me, in my mind, that is a vision for us to scale. And you and I have talked about this
Mhm.
so that you can actually really serve your investors to some degree.
Yes.
Because the investor has a certain amount of money for a certain amount of risk profile. That's why they have different investments. And if they trust you in one way, they might trust you for something else as well. So to me, and also if I study these syndicators who have really grown to a large degree, that's what they've done as well. And it does go back to the who, not how. You really put someone in charge of that line of business. Hey, Sam, you're now in charge of figuring out this debt fund. Go make this thing happen. We'll give you some equity, and you do. And so to me, that is a vision for syndicators in general. The thing they all have in common is raising capital.
Yes, they do. But first of all, like, the term that I love about what you said is that it's almost like building an enterprise, right? That you've got not like a line of business, and any larger company doesn't sell just widgets or just car tires. They sell a bunch of different, not a bunch, but maybe 4 to 5 different things that serve the same client, that you can leverage the infrastructure that you built already on, right? So like what you're doing right there is scaling the capital side of the business and realizing that an investor that walks in the door is not just, maybe they don't want to invest in multifamily today, maybe they're saturated and they either could go find some other thing to invest in, or if Nighthawk or DeRosa Group or whatever provides other things under their enterprise umbrella, then they go, oh, okay, you know what? Let me look at your debt fund, because I've got 3 to 4 multifamily assets. They're fine. I'm happy. I understand where that's going. I need to diversify. I want something else. Or let me look at oil and gas, or let me look at self-storage, or whatever else you got underneath this umbrella. And as long as you scale smart and bring the other sides of the business, acquisitions and operations alongside it, and commit to A+ acquisitions and operations sides of the business, and running it the way that you've run your multifamily operations, talking to all your listeners here, you can certainly do that. Just, I don't recommend doing something like this until you've reached a certain scale in one thing, right? Because if you don't do that, then you're going to be viewed as kind of all over the place, chasing shiny nickels or whatever. But if you've achieved a certain level of success that you can point to in one lane of business, hey, listen, we've done it here, and now we're going to bring that mindset, that success, that brand, that's made everything made that work. We're going to bring it down line into other asset classes we can offer to you, Mr. and Mrs. Investor, as well.
Yeah. So, shifting gears a little bit here, I'd like to. I'm curious about some of the personal disciplines that you have developed over the years that you have found to really contribute to your success. I mean, anything you do, how you get up in the morning, or maybe how you block time, or
Yeah.
anything related to business, or even maintaining life balance. Anything that you can share there.
Sure. And still working on it, right? I'm certainly not optimized yet. I actually heard in our mutual organization, or in GoBundance, I can just say I heard Jesse Itzler. I wasn't lucky enough to be in the room, but I heard him say this in a recording that he said at one of the Champions events. You probably were there, but he says, I try and add a habit once a quarter to my life that will make my life that much better, right? So like whatever that may be. For me, I upped my vitamin game, right? My supplements and those kinds of things. So I'm taking, being, middle-aged man now, right? I mean, things don't work just automatically like they used to. I got to keep myself spry and everything like that. So I'm intentional about my health. And so that means, working out most days, eating well most days. It's like an 80-20 principle kind of thing about I try and do healthy habits 80% of the time. So that means 80% of the time or more taking my supplements, eating a healthy diet, exercising, avoiding alcohol 80% of the time. And then 20% of the time, yeah, having a drink or two. It's okay. But I don't have to be, completely bare bones about it or whatever. But making good choices for my health on that side. And I have a pretty good morning routine that I practice 80% of the time. Except I just give myself grace on the days that I don't, Michael. So my morning routine looks like waking up between 5 and 6. My wife and I got up at 6 a.m. today. And yeah, get up, I drink about a liter of water. I do a meditation, which we did. We did a little reading, and then meditate. And then I journal when I do. Again, when I do, I do. There's a funky little habit, Michael. When I get up in the morning, I put on my gym gear. I don't like just throw on my pajamas. I don't throw on like just what clothes I was wearing the next day or just throw on a pair of shorts or whatever. I put on my gym gear. And sometimes it takes me a little bit while. Like, again, young kids scurrying around. A lot of times they're up right behind me, like right after me and stuff like that. So it might mean getting them on the bus or getting them out the door, getting them where they got to go. And then I do my workout. But when I wake up in the morning, I always put on my gym gear first so that it's like, I kind of don't let myself get ready for my day until I've, sweated up that gym gear a little bit, and then I'm allowed to change into my work outfit.
I find it interesting that you went right to health, which is
Yeah.
interesting, right? You didn't, and here's the thing, I know, and people listening to this probably, you take your health for granted until you no longer have it.
Yep.
Anyone you gets an injury or accident, or you're out for like 5 days, you're like, oh my gosh, health is everything. And I agree, especially the older one gets, it's more and more important. And that leads to having a better, more productive life during the day. And also you sleep better at night, which then makes you better the next day. So I think health is absolutely critical. And just focusing on reading personal development books and doing this, I think that's great.
It's good too.
But really focusing on your health is absolutely important. Well,
I find that it gives me energy, Michael. Like I find that when I eat a healthy diet and when I exercise and I remember to take my vitamins and I remember to do a bit of a morning routine for some mental health, I just feel better. Do I feel like 3 times better? No, I feel maybe 20 to 25% better, but I certainly notice the difference. I could muddle through my day if I don't do those things, but I just feel better. And I've also looked at folks that are a good bit older than you and I are. And those that are still spry in their 70s have told me that it's all about keeping moving. And they either wished they did or are grateful that they did keep their body moving in their 50s and 60s, in their 40s and 50s and 60s, so that the body's ready to keep moving into their 70s and 80s, right? And so I want to be the guy that's still moving around in his 80s in that, which is why I try and move in my 40s, and eat well in my 40s. I don't want to all of a sudden decide to take on good habits and to be healthy with my energy and my body on my 70th birthday. I want to do it now. when I don't have to turn the Titanic around, I can just keep going in the same direction over years and years and years.
Yeah, I found that working out first thing in the morning does not work for me. I do other things in the morning, but I can't work out first thing as my body doesn't get into gear. That's why I take 90 minutes for lunch and I block it out on my calendar so no one can schedule a call with me. And I'll have a 90-minute lunch when I work out, and then it resets
Oh,
the day. So normally how how your productivity kind of goes down well, for me in the afternoon
yeah.
it goes down. So I'll take care of a piddly stuff like emails and stuff that don't require a lot of deep thinking. But I find that having a lunch reset like that actually gives me another pop for like an hour
What do
afterwards.
you do?
Well, during lunch,
Yeah,
I work out, and
you do. So
yeah,
you eat too? So do you work out first and then go eat, or do you eat?
I work out first, and
Okay.
then I either jump in my pool mat or I'll take a shower
Oh,
and then eat, and then I'll sit
oh,
there.
you're a swimmer guy. Or do you do laps?
No, it's not that. It's not an Olympic sized pool, Matt. It's just a normal pool.
I know you I know how you're a roller like that, so I didn't know what kind of a pool we're talking about here, Michael.
Something kind of shocks my system, and I, yeah.
Oh, you're doing the cold thing.
No,
Okay.
no, not yet. Though, of course, we're both surrounded by go abundance freaks who do these crazy things. But no, I am light years away from the cold plunging, and
Oh man, I
I have
used
a
to
lot of
do that.
respect for that torture device. I'm
I
sure.
used to do that. I used to do it, and I felt so good after I did it. But there is nothing harder in the day than to put your own body into cold water, whether that's in a shower or in a. But I can tell you, the way you feel afterwards, I feel like my body's on fire for hours afterwards. Like I feel like tingly. It's great. It's better than any cup of coffee in the world,
I'll,
but it is one of the hardest things you'll do that day. You know.
Matt, I love jamming like this, man. This has been
Yeah.
fantastic. How can people reach out to you and learn more of what you're doing with the DeRosa Group?
They can, well, you just said it. They go to derosagroup.com, DEROSA group.com. Everything there is on the website. Just go to derosagroup.com. If you want to follow me on social, the best place is Instagram, which is just the Matt Faircloth. I took a page out of the Michael Blanc and decided if he's going to be the Michael Blanc, I'm going to be the Matt Faircloth. That's
There's only
it.
one, you know? I love it, Matt. Enjoyed it so much, and I'll talk to you later.
Thanks, brother.